Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Monday everybody. I trust you had a restful weekend and have a productive week ahead. It's the first day of the week, so we begin, as we normally do, with the economy. Over the weekend, we received a series of new economic data, and even though they are official numbers, they don't look especially positive. Let's begin first with the more cautiously optimistic figures. In September, China's exports fell 6.2% from a year ago to $299 billion. Though it was a drop, it was a slower rate than the 8% decline forecast by economists, and a moderation versus the month before. Imports decreased 6.2%, down for 7 months in a row. The resulting trade surplus was $77.7 billion. Analysts argue that the numbers show growing international consumption strength and some limited short-term stabilization in the Chinese economy. However, Raymond Yang, chief China economist at ANZ Banking Group, warns in a weekend note, quote, "China is still slowing down structurally. The spike in the trade data will be short-lived," end quote. Breaking down the numbers by region, exports to the EU dropped almost 12%, to Asian countries down 16%, and exports to the US, Japan, South Korea, and Taiwan all decreased too. Commodity imports from Australia, Brazil, and Russia all rose. The good news ends here, however. The official numbers published over the weekend also indicates consumer prices returned to the brink of deflation in September, reminding us once again just how fragile the economy, and especially demand, remains. According to the National Bureau of Statistics data, the Consumer Price Index, CPI, was near 0% in September from a year earlier, missing the 0.2% gain forecast in both Reuters and Bloomberg polls. Core CPI, which strips out volatile food and energy costs, rose 0.8%. The Producer Price Index, PPI, fell 2.5% from a year earlier, the 12th straight month in negative territory. What are the implications of all this? There is some debate among economists. Quote, "The slip in China's CPI back to zero inflation in September indicates demand remains too weak to stoke prices. Green shots in manufacturing suggest the economy is starting to turn around, but it will probably take time for demand to pick up broadly on the back of the increase in policy stimulus in recent months," end quote. And, quote, "While both CPI and PPI numbers came in lower than expected, I think it's a mistake to say that China is in deflation. September is the third month during which we've seen rising month-on-month CPI prices, and the second month for PPI. The news isn't great. Clearly we are not in the midst of a brisk return of demand, but today's numbers are still consistent with the idea of slow, albeit temporary, recovery in the economy in the second half of 2023, end quote. And, quote, "Deflationary pressure in China is still a real risk to the economy. The recovery of domestic demand is not strong without a significant boost from fiscal support," end quote. Whether that fiscal support comes, and to what degree, will depend in part on more figures to be released this coming Wednesday. The statistics on everything from industrial output to employment for Q3, and thus the first 3 quarters of this year, will show analysts, the market, and policymakers whether the government's recent stimulus is helping stabilize activity or not. We will be following the release very closely. Larry Hu, head of China economics at Macquarie Group Limited, told clients over the weekend, quote, "There are 2 scenarios. 1, these piecemeal efforts will add up eventually. 2, at a certain point, the policy stance will turn more decisive as patience is exhausted," end quote. But already this unexpectedly low CPI will be hitting confidence in fiscal support effectiveness hard. Quote, "The government has announced hundreds of counter-cyclical measures to boost domestic demand, yet consumer confidence remains weak," end quote. Despite this, however, quote, "There is a lot of optimism around a bazooka stimulus. We think the probability is relatively small for anything too exciting, but policy easing will continue with more measures on multiple fronts," end quote. In September, the People's Bank of China increased its gold reserves for an 11th straight month, a move suggesting the central bank remains concerned about an increasingly uncertain world. And it is not alone. According to the World Gold Council, a quarter of central banks intend to increase their holdings over the next 12 months amid increasing pessimism toward the future role of the US dollar. Private investors are making similar moves, increasing their exposure to the precious metal as a hedge. At uncertain and unstable times like this, it is gold that the smart money turns to, and that is why today's video sponsor, Gold Mining Inc., is a great opportunity for investors. We have discussed Gold Mining Inc. before. The New York Stock Exchange traded company is a public mineral exploration company focused on the acquisition and development of gold assets. 3 factors make Gold Mining Inc. stand out as an attractive pick. First, Gold Mining Inc. boasts a unique combination of sizable resources and balance sheet strength. Through its disciplined acquisition strategy, Gold Mining controls a diversified portfolio of resource-stage gold and gold-copper projects in Canada, the United States, Brazil, and other locations in the Americas. Second, the company has an impressive management team, each leader with decades of experience in the industry, and the co-chairman is the ex-CEO of the world's largest gold company. These guys know what they are doing. But it's the third factor that really makes Gold Mining Inc. stand out. Some analysts argue this company is extremely undervalued, making it an attractive bet for savvy investors with well-diversified portfolios. Currently, Gold Mining Inc., minus what it owns in other companies, has a market cap of approximately $158 million. Gold Mining Inc. owns a total of 14 gold projects with a combined amount of 32 million ounces of gold reserves, meaning it's in the ground, it's been discovered, but it has not yet been mined. These resources, if realized, would price them at the current market value for the company at $4.93 per ounce, over 80% lower than the industry average of $30 an ounce. This is where there is great upside potential for investors if mining operations prove successful. This is a speculation of sorts, some risk, but also the potential for high reward. Investors looking to take advantage of this excellent opportunity should check out Gold Mining Inc. on the New York Stock Exchange. We remember that all investment involves risk. This is not individual investment advice. Always speak to an investment professional before making any investment decision. A big thank you to Gold Mining Inc. for once again sponsoring this episode of China Update. Okay, we now return to regular content. Over the weekend, UK-based Financial Times and several other outlets reported that Beijing is indeed weighing the formation of a state-backed stabilization fund to shore up confidence in its $9.5 trillion stock market, a move we anticipated on China Update last week when we covered the purchase of $65 million of shares in the nation's biggest banks by China's sovereign wealth fund. The Financial Times writes that China's financial sector authorities have proposed setting up a stock market stabilization fund to boost flagging confidence among domestic investors. 4 unnamed sources told the outlet that Beijing is considering the plan, quote, which will probably invest in domestic equities through existing financial institutions and professionally managed funds, end quote. The government money would be matched by its partner funds and institutions. 2 of the people said that financial sector regulators, including the stock market watchdog, the China Securities Regulatory Commission, as well as the Ministry of Finance, have submitted the proposal to the State Council, which would ultimately decide how the proposed fund would operate. It's reported that the program would need to raise at least 1 trillion yuan, $137 billion, to be effective, with a government advisor reportedly telling the outlet, quote, the fund needs to be big enough to influence the market. A few 100 billion yuan isn't enough to boost confidence, end quote. China's sovereign wealth fund has a history of intervening during times of extreme turbulence, including when it brought stocks after bubbles burst in 2008 and again in 2015. The same government advisor added, quote, we need a stock market boom to make households wealthier so they can spend more, end quote. However, one prominent commentator reacting to this comment online expressed, and yet there are much better ways, more effective and more sustainable, to make households wealthier. Next up, and finally for today's video, I wanted to examine a note published over the weekend by Wang Tao, chief China economist at UBS Investment Bank, on the bank's outlook on China's property sector. The note is particularly useful as it touches on several key themes which we'd like to keep an eye on. We will end by quoting several key parts of the note directly. China's property activities weakened notably in the second quarter and early third quarter after a short-lived rebound in the first 3 months of 2023, weighing on the recovery of the economy. Our survey, conducted between the 7th of August and the 30th of August, before the recent acceleration of property policy easing, showed buying intention and sentiment weakened in August. The share of respondents planning to buy a house in the next 2 years edged down further to 18% from 23% in March and 30% in August 2022. This is the second lowest reading since the survey started in 2015, above only the September 2021 reading of 11%. The weaker buying intention, softer confidence, and cooler price expectations point to worsening sentiment in the housing market. Market sentiment may have improved a bit in September. China has been accelerating property policy easing since the end of August, including lowering the minimum down payment requirement and minimum mortgage rates for second home buyers across the country, removing buying restrictions in over 10 second-tier cities, and relaxing mortgage rules in many large cities, including first-tier cities. We think these easing measures may help underpin market sentiment, especially in higher-tier cities. Property sales in major cities already improved in September. The note is far less optimistic when it comes to lower-tier cities, however. We continue with the quote, "Overall, we expect property sales to decline by 10% in 2023 and by between 5 and 10% next year. New property starts by floor space to contract by 25% and 10%, and real estate investment to fall by 10% and 5%. To boost confidence in the market, income growth and policy easing are the most important factors, according to the survey, which points to a continued but halfway income growth recovery. However, urban households continue to accelerate excess savings throughout the first half of this year, a lingering headwind on consumption recovery." Here ends the direct quote in today's episode of China Update. If you enjoyed the episode, don't forget to hit the like button. China Update is now on Twitter. There's a link in the description below. Thank you so much, everybody, for watching. I hope you have a wonderful Monday, and I will see you all tomorrow.